Alejandro Ventura here with one of my preferred lenders, Greg Conley. We're trying something new today, going live not only on Facebook and YouTube, but also on Instagram. I have to set up my phone right next to my PC. So that's why I'll be alternating, uh, viewing the two devices. But, anyways, we want to resume our weekly real estate conversations in an effort to, again, keep you informed and letting you know what's going on in the real estate industry. And today we'll be kicking it off with the question in everyone's mind, which is what is going on with interest rates? How come they've risen so quickly and to these levels? What's the dynamic behind these fluctuations and increases? uh, where are interest rates today and what to expect going forward. So, to that end, I think Greg has put together a presentation for us. So, my friend, take it away.
Yeah, thanks, man. Thanks for having me. It's good to be here with you. Um, yeah, couple slides just to help guide our conversation. But yeah, the magic question is absolutely what's going on with interest rates. Why are they so high? Why are they staying high? And are we going to get any relief anytime soon? So, um, Alejandro, do you have my
I do.
screen shared?
So, there it is.
Cool. All right. So yeah. So um, as of today, national mortgage rates
Hey, Greg,
are
just before we uh, get much further, for
yeah, yeah.
anyone watching on Instagram, if you want to switch to my Facebook page, just Alejandro Ventura, you'll be able to see the slides uh, Greg is about to cover. We're just going to figure out how to do the same on Instagram. So, for those of you interested, just switch to that account and you'll be able to see all those numbers. All right.
And I'll do my best to articulate them for those of you that aren't able to make the switch. So national rates, and this is just like a survey of lenders across the country, and this is assuming no points. So you're not buying your interest rate down at all. Our national rates for a conventional 30-year fixed loan at 7.37, an FHA loan 30-year fixed at 7.05, and then a 5-year ARM, adjustable rate mortgage. Oh, it says 30-year fixed, but 5-year ARM at 7.01. Okay. So those are where the averages are today. The biggest question everybody wants to know is why, and both in terms of your personal file if you're applying for a loan, and in terms of the economy at large. There's a huge number of reasons as to why rates are up, but in order to kind of distill this into a helpful conversation, the biggest thing is inflation. The biggest thing is inflation, and this is a conversation. It's a buzzword that we've been hearing about since early 2022. But the Federal Reserve, the central bank for the United States, its job is to monitor the economy and keep the economy inside a range of health, both in terms of growth but not too much growth, and protecting it from huge recession. And so when you get into a period of inflation, the biggest tool that the Federal Reserve has at its disposal is increasing interest rates. And so that's what they've been doing since 2022. They've been increasing the benchmark interest rate, which makes it more expensive for any sort of lending, any sort of credit-based lending. So if you're getting a new car loan, if you're getting a home loan, if you're getting a personal loan, any of that stuff, your interest rates are going to go up because the Federal Reserve is driving the interest rate up. The idea there is that as everything gets more expensive because interest rates are higher, hopefully people stop spending less money. As people stop spending less money, costs of goods and services comes down, and we see this slow decline in inflation. And we have started to see that, right? We have started to see that. We've seen inflation come down from 9.1% last summer all the way down to 3.2% in our latest iteration of monthly inflation measurements. So we've been moving the right direction, which is great. The tricky part, and the reason that we're not out of the woods yet, is that despite the fact that inflation's been coming down, all of the economy's numbers have been really, really good. Unemployment is still below 4%. Job growth is still strong. Wage growth is still strong. And so the thing that the Federal Reserve has been communicating is that if job growth is still strong, if wage growth is still strong, they want to wait out with higher interest rates to make sure that they don't just eliminate all the progress we've made. So inflation's come down. We're not out of the woods yet. And so it seems like what's being communicated is that we're going to have a holding period where things are going to kind of stay where they're at for probably I would think a few more months, maybe. It'd be my projection, my guess. And the Federal Reserve is going to watch the data and see what happens.
One thing to keep in mind, one is that there is no certainty as to where rates will be, either near, midterm, or long term. So I'll say be cautious of anyone who offers any kind of guarantees as to where rates will be at any given point in time. Two is this forecast continue to be revised. For example, when rates began increasing last year, the forecast at the time from these experts was that by the end of this year, rates would have been back down to 6, maybe 5 range. And guess what? Today we are in the 7.5 range. And now the goalpost has been moved. And like Greg is saying, now the expectation is for rates to come back down either at the end of 2024, and some are saying even into 2025. Is all data dependent. So the reason why this is important to keep in mind is because there is a philosophy going around in the real estate industry that preaches the term, they use or we use is marry the house, date the rate. And essentially, what that implies is that you should take advantage of the lower prices, home prices that we have currently seen in the market, even if you have to buy a higher than comfortable rate. Let me just stop this for a second. This
Yeah.
picture. So essentially, what that implies is that go ahead and buy a house at a lower price point today, even if you have to take on a higher monthly payment by virtue of having a higher rate, because a purchase price is permanent, whereas a mortgage rate, it can be temporary. It can be changed by refinancing sometime in the future. And the risk with this approach is that if you buy on more that you can chew, financially speaking, you might end up in a tough financial position because once again, there is a lot of certainty in the market as to what's going to happen with rates, when they will adjust downward. And in the meantime, you might end up again beating or biting a higher monthly payment that puts you in a precarious financial situation. So everything we're sharing now is not to offer guarantees, but just to keep you informed as to what's going on.
Yeah.
Now, to bring that on a more practical level, offer some scenarios, Greg, as to how these rate changes affect monthly payment, say on a 450,000 price point.
Sure. Yep. Gonna go back to our screen here. Okay. So these are the projections that Alejandro was talking about. These are people who are pretty smart, but at the same time, all of these projections have shifted upwards based on data. So to Alejandro's point, these are just projections. People are doing their best to kind of look at economic indicators and see what they think will occur. A couple of folks saying kind of mid 6s by the end of 2023, by the end of 2024, down to 5.9, But just like Alejandro said, these are just projections, and those projections have shifted dramatically over the course of the last 12 months. So keep that in mind. When we talk about a $400,000 purchase price, and the numbers that I used here was 450,000, 5% down with a 720 credit score. And I mentioned that because of mortgage insurance, which we can talk about in a second. I input $100 a month for homeowners insurance and $350 a month for taxes. Those are estimates. That'll be property specific. But if we use the current national average today for a conventional loan at 450 grand for a purchase price with 5% down, that would be a monthly payment of $35.36 per month. If we used the projection for the end of 2023, 6.4%, that brings that payment down to $32.59. If we go to the end of 2024 projected interest rate of 5.9%, excuse me, that puts us at $31.21 per month. So, obviously there's a pretty big swing in a monthly payment based on interest rate.
So hold on there. So rate change of, say, from 7.37 down to 5.9, that is almost 1.5.
Mm-hmm.
So the impact on that on a monthly payment is roughly 400. Is that right?
$400. Yep.
Okay. Sorry, keep going.
Yeah. No, that was all. So when you look at numbers like this, it's helpful to. Here's what I would say: have a plan, right? If you are in a position where you're buying a house right now, regardless of if it's because you feel like you have to or because you've decided you want to, have a plan, not just for this transaction today, but for the next 2 to 4 years for how you're going to address your interest rate. Because as much as we want to be cautious in the way we project, history suggests, based on the economic indicators that we have, that this 7.37 is not forever. How fast it will come down, when it will come down, it gets a little bit more murky there. But the fact that it will come down seems to be almost universal. And so how do you plan and what do you intend to do when rates come down? And how does that impact the decision you would make today on how to approach your loan? Those are going to be really, really important questions and thoughts to have and conversations to have with your lender. Perhaps your agent has some advice for you. But asking those questions, not just thinking about the transaction right now, but thinking about this as like a multi-year process is going to put you in a position to be more successful down the road.
Yeah, definitely. And another point that is also relevant: these numbers are par, meaning this is without any discount points, correct?
Correct.
So, and I'm speaking anecdotally, right, based on my experience and those of I work with directly. Hardly ever I see anyone actually paying par on a rate, which means that you have still the option to buy down the rate to a more competitive one. So can you tell us, Greg, a little bit about the cost and how that functions and works?
Yep. So interest rates, every single interest rate for any loan has a price tag. So the ones that are on the screen, their price tag is $0. It doesn't cost you anything to obtain that interest rate, at least based on projections, right? The lower your interest rate gets, the higher the price tag is. So for example, if we use 7.37 as our benchmark, and I say, okay, 7.37 is a free interest rate, and you say, well, I'd really like to have an interest rate of 6.75. Then I would look in my system and say, okay, based on your credit score, based on your down payment, based on your cash reserves, based on 15 to 20 different items that are in my system already, I would say, okay, the cost of 6.75% is going to be, say, 1% of the loan amount. Because the price tag for interest rates are always in percentages of the loan amount. So if that's the case, on a $450,000 purchase price. To get down to 6.75, those 1% of the loan amount would cost you around $4,000. And that would be a fee that you would pay at closing. So the question when you buy points is always going to be, if I decrease my monthly payment, right? I go from 7.37% down to 6.75%. How much did it cost me to do that? And how much do I save each month? So if you save, let's just use really round numbers. If you save $100 a month, but you had to spend $4,000 to get there, right? That's going to take you 40 months to make that money back. And so the question always becomes, do you think that you will refinance inside of 40 months? If so, be mindful of spending too much money up front because you won't recoup it with that lower monthly payment. So that's why I say have a plan. Make sure you communicate that plan with your lender. And if you don't know what the plan is or what the plan should be, just ask questions. Hey, I've heard about this break-even thing. Hey, do you think I should spend money on points or not? How come? Help me understand, right? Have that conversation with your lender. Again, ask your agent for advice as well. They're in this industry. They know what they're talking about, and they can direct you to what questions to ask, what to think about. Because yeah, I mean, most of the time people don't take a par rate, but right now, more people are taking either par or nearly par because they don't want to spend a bunch of money on an interest rate because they're assuming that they will refinance inside of the next 2 years.
That just makes the back of my hair, stand up because, and again, only you as a buyer can make that call. If you have the resources, if you have the income to, take on a 7.5 rate until rates adjust down, by all means. This approach to agree or commit to a higher interest rate with the expectation to refinance at some point is valid. What I'm saying is that it's not a blanket solution for everybody. And some
Correct.
people may get in trouble by taking that approach, whereas for others might be the right option. So just like Greg says, ask questions and talk to people who have, a good working understanding on numbers, on how rate works, so they can guide you, so you can make your own informed decisions. Um, you said something else here that I forgot. While I think of it, is there anything else you want to add?
Just a comment about FHA versus conventional if you wanted to jump
Yeah.
into that. Do you want to do that?
Yeah.
Okay. One thing to consider for anybody who does not and is not putting 20% down, and I mentioned that number because if you don't put 20% down, you'll have some sort of mortgage insurance, be it upfront mortgage insurance or monthly mortgage insurance. If you have a conventional loan, you'll have some sort of mortgage insurance. If you're not putting 20% down, ask your lender to run the numbers on an FHA loan. It may not be more beneficial, but earlier in 2023, FHA decreased its mortgage insurance requirements, making it more affordable, cheaper on a monthly basis to have an FHA loan. And FHA loans tend to get kind of a bad rap, but the reality is that most times FHA rates are lower than conventional, in some cases significantly lower, 0.5% in some cases. And so even if you have a good credit score, it may be worth identifying what's the difference, and is it worth taking on an FHA loan because my payment would be like what's the threshold where you would say, oh, I'm going to do FHA because the payment is significantly cheaper? What is that number, right? Knowing what that number is for you. The trade-off is that FHA mortgage insurance never goes away. Doesn't matter if you have 20% equity in your home, mortgage insurance is always, always, always there on an FHA loan. So again, having an exit strategy is important. So if the plan always, conventional or FHA, was to refinance, it's worth taking a look at the FHA numbers because it may save you a couple $100 a month.
One clarification there, and
Sure.
I believe FHA, MI does go away with 10% down. You guys can double check on that. Uh,
At the point of purchase.
right. So if you, instead of just going with a minimum of 3.5, if you go the FHA route with 10% down, uh, then at that point, MI is not permanent. But again, you guys can double check on that.
Yeah.
One
Also,
question, um, a question for you. So let's say that someone again is buying a 450 and they have plenty of cash on hand to do more than 20% down and to buy down the rate to the lowest amount possible. You mentioned that there is a risk of overspending when it comes to getting discount points if you're thinking about refinancing in the near future.
mhm.
So, for someone who is in this position, what would you recommend to them on how to best use those resources? Should they use most of it or all of it to permanently buy down the rate? Should they use most of it to temporarily buy down the rate via a 2-1, 3-1 buy down, or perhaps a combination of the two? What would you say?
My first question before I would give any advice would be, what is your priority with how your mortgage fits in to your entire budget? Meaning, uh, if in most instances, somebody who has a decent amount of cash, enough to put 20% down and additional cash on top of that, they may be a touch less sensitive to fluctuations in $50 to $100 on a monthly basis, to $150. So I would want to know, do you have a hard cap? If so, why? How does your mortgage fit into your long-term plans? My tendency, this is again, you talk about anecdotal things. This is my personal preference, is to hang on to excess cash rather than dumping it into a mortgage over and above, say, 20%, or spending a ton of money on discount points. Because I think that generally speaking, there are more efficient ways to utilize your cash outside of your house, right? So if you put an extra $10,000 into your mortgage as a part of a down payment, saves you $65 a month. So I would say that in general, you could probably do better with that $10,000 somewhere else. Now, if someone who's really sensitive and they have a hard cap on their budget, then yeah, I would say, okay, let's take a look at buying down the rate permanently. Let's take a look at a 2-1 buy down. But I would first need to know, what is the priority inside of somebody's kind of like whole personal budget, right? And where does it fit? I will say that I'm not super biased towards a 2-1 buy down or a 3-2-1 buy down, because they're pretty expensive and effectively you're paying the same. You're just taking the difference in payment between the highest rate and the lowest rate, and you're tucking that money into an escrow account, and then it's coming out later. So my preference in that scenario would be to spend some extra money on a rate if I had to choose between a buy down or bringing a rate down by using discount points. If I was going to spend the money anyways, I would try to bring the rate down permanently rather than temporarily. Sorry, guys, I'm getting a phone call here. So that would be my bias.
Yeah, no, that makes sense. And I think along the same lines, uh, in terms of have a more in-depth conversation about your financial priorities versus offering a one can solution for all. So I do believe that in certain situations, doing a combination of the two might make sense. It just depends, like if you're expecting an increase in your income in the next 12, 24 months, then doing a combination of a permanent and temporary uh, buy down might be a viable, sensible option for you.
Mm-hmm.
If you don't expect any changes in your income in the near future, than going the more conservative, safer route, buying it down permanently might be a better option for you. It just now they're calling me. Um, so good, good. So to to recap, rates right now are in the mid sevens, and that's actually down because I believe a few weeks ago they were nearing 8%. The expectation is for rates to stay at that level, maybe even go higher. The Feds are meeting two more times this year. I believe it's September and December.
Mhm.
And some say that another increase uh, is on the books. Now, if they do decide to keep it the 7.5 level, or I mean, they don't decide that, but if they decide not to make any
To
further
increase.
increases, given by judging by history, what happened back in 2007, 2006, right before or eight, right before the Great Recession, when they stopped hiking rates, there was a holding period of I believe it was 8 to 9 months. So if that happens again, let's say that they stop increasing rates by the end of this year, rates might remain at that level through the end of 2024. So just keep that in mind. Um, as for how that's impacting home prices, without a doubt, it is putting downward pressure on prices. But that's
Mhm.
different than saying that prices are collapsing. The actual data is here in Spokane, the median sales price is down 4% from a
Mhm.
year ago, which is more of a correction than a market crash. As to what to expect going forward, I expect prices to stay at that level, uh, primarily because of the inventory. Inventory of houses for sale remains pretty tight, two
Mhm.
months, 2.5 months. Uh, give, and again, this is because of rates. Many sellers are reluctant to give up a 3%, 3.5% rate on their current houses to buy a next one. So, all that to say, do not expect the market to crash locally anytime soon. Highly unlikely. And when it comes to buying a house, just like Greg said, have a budget and stick to it. Any final thoughts?
I think just generally keeping in mind that there's a huge degree of nuance to all of this, and your personal situation is certainly impacted by these global phenomena and national phenomena, but there's also going to be like how your personal situation is impacted by your credit score, your income, your down payment, right? So just understanding that what we're talking about are trends, and that matters, but having a really in-depth personal plan and detailed conversation with your lender to understand your situation best, in addition to the trends, is critical. Ask a million questions, right? And if a lender's not willing to work through it with you, find a different lender. There's lots of people that'll lend you money. So make sure that you know and feel comfortable with the information that you're being given for your personal situation.
I love it. Just one, now you just made me think of another concern when it comes to talking to different lenders
Mhm.
is that people feel that every time they submit an application with a different lender, that their credit's going to take a hit. So just know that that's not the case. The system is designed to give you the opportunity to shop around with different lenders within a 30-day period without taking an additional hit on your credit. It all counts as one hard pull on your credit, so long as these inquiries are mortgage related. So if you go out and apply for a car loan or a credit card loan, then that's different. But if you're just simply shopping around for mortgages, you do have this opportunity. So you might as well take advantage of it. All right. Well, thank you all for watching today. We'll be back next week. Have a great weekend, and we'll talk soon.
All right. Bye, guys.
Okay, I think we're done. All right, buddy. What do you think?
Looks like we're still